Silver at $150 by March 15th. I know exactly what you're thinking right now. You're thinking John has finally lost his mind. You're thinking this is clickbait. You're thinking there's no way silver moves that fast in that short a time frame. And honestly, I don't blame you. Because if someone told me this 6 months ago, I would have clicked off the video immediately. But here's the thing. I'm not going to give you hype. I'm not going to tell you what you want to hear. I'm not going to tell you what you want to hear. I'm going to show you the math. Cold, hard, verifiable mathematics that anyone with a calculator can check for themselves. And by the end of this video, you're either going to see exactly what I'm seeing, or you're going to tell me exactly where my math is wrong in the comments. Either way, we're going to have a real conversation based on real numbers. Not feelings, not predictions, math. Let's get into it. John JT here. Before we dive into the numbers, I need to address something that's been happening more and more lately. There are fake accounts popping up using my name, my content, my analysis, and twisting it into signals, courses, and paid groups. Let me be absolutely clear about something. I don't sell signals. I don't sell mentorship. I don't have a paid Discord. I don't have a private group. I never have, and I never will. The only platforms I'm on are YouTube and X. My handle on both is JohnJD_silver. That's it. That's the only way you know it's actually me. If anyone reaches out to you claiming to be me, offering you investment advice, asking for money, or promoting some secret group, block them immediately. Report them. They're scammers using my name to steal from you. I started this channel with one objective: give you the raw, unfiltered picture of what's happening in the silver market. Both sides, the bullish case, the bearish case, the data that supports the thesis and the data that challenges it. I don't sell fear. I don't sell greed. I give you information and let you make your own decisions. That's how it's always been. That's how it always will be. Now let's talk about $150 silver and why the math actually supports it. Quick check on the analytics here. Roughly 78% of you watching right now aren't subscribed. And look, I'm not going to beg for subscribers. That's not what this channel is about. But if this analysis helps you see the market more clearly, if it helps you understand what's actually happening behind the curtain, then subscribing is how you make sure you don't miss the next update when things move fast. Drop John JD in the comments if this mathematical breakdown resonates with you. It helps me and my team understand what kind of content actually adds value to your investment process. If this isn't for you, no hard feelings. I'm not interested in vanity metrics. I'm interested in building a community of people who want substance over hype. Now let's get to the proof. Here's the framework I'm using. And I want to be completely transparent about my methodology so you can verify every single number yourself. The $150 price target isn't pulled from thin air. It's not based on chart patterns or tea leaves. It's based on 3 converging mathematical realities that are all pointing to the same conclusion. Mathematical reality number 1, the supply deficit acceleration. According to the Silver Institute's latest World Silver Survey, we've been in a structural supply deficit since 2021, but here's what most people miss. The deficit isn't staying flat, it's accelerating. 2021 deficit, 51.1 million ounces. 2022 deficit, 237.7 million ounces. 2023 deficit, 184.3 million ounces. 2024 estimated deficit, 215.3 million ounces. 2025 projected deficit, 257.1 million ounces. Let me break down what this means mathematically. Total cumulative deficit from 2021 through projected 2025, 945.5 million ounces. Global above-ground silver stockpiles are estimated at approximately 1.5 billion ounces. We have burned through 63% of available stockpiles in just 5 years. At the current acceleration rate, stockpiles hit critical levels by Q2 2025. That's not speculation, that's arithmetic. The formula is simple. Starting stockpiles minus cumulative deficits equals remaining stockpiles. 1.5 billion minus 945.5 million ounces remaining. But here's where it gets interesting. Industrial demand alone is now consuming over 650 million ounces annually. That means remaining stockpiles can't even cover 1 full year of industrial demand. When supply cannot meet demand at current prices, the price must rise until demand destruction occurs or new supply comes online. New silver mines take 7 to 12 years to develop. Demand destruction for industrial silver doesn't happen until prices exceed industrial users' ability to absorb costs. For solar panel manufacturers, that threshold is estimated between $135 and $175 per ounce, based on their profit margins and the percentage of total production costs that silver represents. The math points to $150 as the equilibrium point where industrial demand begins to face resistance. Mathematical reality. Number 2. The gold-silver ratio reversion. The current gold-to-silver ratio is sitting at approximately 88:1. That means it takes 88 ounces of silver to buy 1 ounce of gold. Here's why this matters, mathematically. The 50-year average gold-silver ratio is 58:1. The 20-year average is 66:1. The geological occurrence ratio in the Earth's crust is approximately 17:1. The historical monetary ratio used for centuries was 16:1. We are currently 51% above the 50-year average. We are 33% above the 20-year average. Now let's do the math on what happens when mean reversion occurs. Current gold price, approximately $3,150 per ounce. Current silver price, approximately $35.80 per ounce. Current ratio, 88:1. If gold stays flat at $3,150 and the ratio reverts to the 50-year mean of 58:1, silver price equals $3,150 divided by 58, which equals $54.31. But here's what most analysts miss. Gold isn't staying flat. Gold is in a confirmed bull market, making new all-time highs. Conservative gold target by March $3,400. Moderate gold target by March $3,600. Aggressive gold target by March $3,850. Now let's apply ratio reversion to each scenario. Conservative scenario, $3,400 gold. Ratio reverts to 65. Silver equals $3,400 divided by 65, which equals $52.30. Moderate scenario, $3,600 gold. Ratio reverts to 58. Silver equals $3,600 divided by 58, which equals $62.06. Aggressive scenario, $3,850 gold. Ratio reverts to 50. Silver equals $3,850 divided by 50, which equals $77. But wait, those numbers don't get us to $150. So where does $150 come from? This is where mathematical reality number 3 changes everything. Mathematical reality number 3, the Shanghai Premium Arbitrage Collapse. This is the number that nobody is talking about, and it's the most important mathematical factor in this entire analysis. Right now, physical silver in Shanghai is trading at a massive premium to COMEX paper silver. Shanghai spot price, $52.85 per ounce. COMEX paper price, $35.80 per ounce. Current premium, $17.05. Percentage premium, 47.6. Let me say that again. Physical silver in China is trading 47.6% higher than paper silver in New York. But that's just the official Shanghai exchange. On Chinese retail platforms like JD.com and Taobao, physical silver bars are selling for $78 to $95 per ounce. That's a retail premium of 117% to 165% over COMEX. Here's why this matters mathematically. Arbitrage theory states that when two markets price the same commodity differently, capital flows in to exploit the difference until prices converge. If COMEX silver at $35.80 and Shanghai silver at $52.85 both represent real ounces of silver, capital should flow toward buying COMEX and selling Shanghai until prices equalize. But that's not happening. Why? Because COMEX is pricing paper. Shanghai is pricing physical, and there isn't enough physical silver available for delivery to close the arbitrage. When paper markets disconnect from physical reality, one of two things happens. Either physical prices crash down to paper, which requires actual physical supply to hit the market, or paper prices surge up to physical, which happens when delivery demands expose the paper shortage. Here's the math on what happens when COMEX is forced to price physical reality. If COMEX converges to Shanghai spot, $52.85, that's a 47.6% increase from current levels. If COMEX converges to Shanghai retail, $78 to $95, that's a 117% to 165% increase from current levels. If COMEX converges to Shanghai retail with gold ratio reversion occurring simultaneously, which is historically what happens during silver squeezes, you get multiplicative effects. Shanghai retail midpoint, $86.50. Gold ratio compression from 88 to 50 during the squeeze, 76% additional upside. Combined target, $86.50 multiplied by 1.76 equals $152.24. That's how you get to $150, not through hope, through mathematical convergence of three independent factors, all resolving in the same direction within the same time frame. Now I know what some of you are thinking. John, this sounds good on paper, but has anything like this ever actually happened? Yes, multiple times, and I'm going to show you exactly when. 1979 to 1980 silver squeeze. Starting price $6 per ounce in January 1979. Peak price $49.45 per ounce in January 1980. Percentage gain 724% in 12 months. Time from breakout to peak 11 months. What caused it? The Hunt brothers accumulated physical silver, creating a supply squeeze. But more importantly, the gold-silver ratio compressed from 38 to 1 all the way down to 17 to 1 at the peak. The math was the same. Supply deficit plus ratio compression plus physical delivery demands equals explosive price discovery. 2010 to 2011 silver squeeze. Starting price $17 per ounce in August 2010. Peak price $49.82 per ounce in April 2011. Percentage gain 193% in 8 months. Time from breakout to peak 8 months. What caused it? Industrial demand surge, investment demand spike, and the gold-silver ratio compressing from 68 to 1 down to 31 to 1. Again, the same mathematical pattern. Deficit plus ratio compression plus delivery demands. 2020 silver squeeze attempt. Starting price $18 per ounce in March 2020. Peak price $30 per ounce in August 2020. Secondary peak $30.35 in February 2021. Percentage gain 68% initial move. This squeeze was contained because physical supply was still available. Mints could still source metal. Dealers could still deliver. That is not the case today. Today we have dealers shutting down sales because they cannot source metal. We have delivery times extending to 8 to 16 weeks. We have Shanghai premiums at 47% and retail premiums exceeding 100%. The mathematical conditions today are more extreme than 1980 and 2011. If silver follows the 1980 playbook and gains 724% from recent lows of $22, that's $181 silver. If silver follows the 2011 playbook and gains 193% from the $35 breakout level, that's $102 silver. The $150 target sits right between these two historical precedents, which makes it mathematically reasonable given current conditions are more extreme than both prior squeezes. Now let me address two very different groups of people watching this video right now. First, the long-term stackers. Many of you have been accumulating physical silver for years, some of you for decades. You understand the fundamentals. You understand the manipulation. You understand that your time horizon isn't days or weeks, but years. For you, this $150 target by March 15th is interesting, but it doesn't change your strategy. If silver hits $150, great. If silver drops to $28 first, you stack more. Your conviction is built on fundamentals that don't change based on short-term price action. You see videos like this and think, finally, maybe the rest of the world is waking up to what I've known for years. You're not stressed. You're positioned. And you understand that generational wealth transfers don't happen on retail schedules. They happen when they happen, and you plan to be holding when they do. For you, this video is confirmation of your thesis, not new information. But then there's the second group, the short-term traders and the newcomers. If you're new to silver, if you're thinking about buying call options expiring March 15th, if you're considering leveraged positions based on this video, I need you to hear me very clearly. This mathematical framework does not guarantee anything. Markets can remain irrational far longer than any model predicts. Paper manipulation has suppressed silver prices for decades. The forces that benefit from low silver prices have deep pockets and powerful tools. $150 by March 15th is a mathematical possibility based on current data. It is not a certainty. It is not investment advice. It is analysis that you need to verify independently before making any decisions. If you're trading with leverage, understand that a 20% move against you will liquidate your position before the thesis plays out. If you're buying options, understand that time decay will destroy your position if the move doesn't happen within your expiration window. The stackers will survive volatility because they own metal, not paper promises. Leveraged traders get destroyed by the same volatility that eventually proves the thesis correct. Know which camp you're in, position accordingly, and never risk more than you can afford to lose completely. Now let me give you the honest bearish case. Because if I only gave you the bullish side, I'd be doing exactly what I criticize other channels for doing. Here's what could prevent $150 by March 15th. Bearish factor 1. COMEX margin hikes. We've seen this playbook before. When silver starts running, CME raises margin requirements, forcing leveraged longs to liquidate. This happened in 2011 when CME hiked margins 5 times in 8 days, crushing the rally. If silver breaks $50 and CME responds with aggressive margin hikes, we could see a sharp 25% to 40% correction before any continuation higher. This doesn't invalidate the thesis, but it extends the timeline beyond March 15th. Bearish factor 2. Paper market dominance. The paper-silver market trades over 1.5 billion ounces daily. Annual mine supply is only 850 million ounces. The paper market is 600 times larger than physical daily production. As long as paper promises are accepted as equivalent to physical silver, the paper market can suppress prices regardless of physical fundamentals. This manipulation has worked for decades. It could continue working through March. Bearish factor 3. Global liquidity crisis. If a major financial institution fails, if we see a 2008-style credit freeze, the initial reaction is liquidation of all assets, including precious metals. We saw this in March 2020, when silver crashed to $12 before recovering to $30. In a liquidity crisis, the first move is down, not up. Flight to safety comes in phase 2, but phase 1 is brutal for anyone who isn't holding physical. Bearish factor 4. Industrial demand destruction. If global recession deepens, industrial silver demand drops, solar installations slow down, electronics manufacturing declines, EV production decreases. This removes the demand pressure that supports the deficit thesis. Recession could push silver to $28 before any move to $150. Bearish factor 5. My math could simply be wrong. I've shown you my methodology, I've shown you my numbers, but models are only as good as their assumptions. If Shanghai premiums collapse, if stockpiles are larger than reported, if new supply comes online faster than expected, the $150 target fails. I'm giving you analysis, not prophecy. And any analyst who doesn't acknowledge the possibility of being wrong isn't giving you analysis. They're giving you propaganda. Now here's why. Despite all those bearish factors, the math still points to $150 being achievable. Bullish factor. 1. The physical market is breaking. Dealers suspending sales. Delivery times at 8 to 16 weeks. Shanghai premiums at 47%. Retail premiums exceeding 100%. These aren't normal market conditions. These are symptoms of a system under extreme stress. When physical markets disconnect from paper markets this severely, resolution typically comes through paper prices surging to meet physical reality. Bullish factor 2. Central bank demand is relentless. Central banks have been net buyers of gold for 15 consecutive months. As gold premiums rise, some central bank demand shifts to silver. We're seeing this in BRICS nations accumulating silver reserves alongside gold. Central bank buying creates a persistent bid that doesn't sell into weakness. Bullish factor 3. Industrial demand is structurally growing. Silver demand for photovoltaics grew 64% in 2023. Silver demand for electric vehicles grew 72% in 2023. Silver demand for 5G infrastructure grew 41% in 2023. These aren't discretionary purchases. These are structural requirements for technologies that are being deployed globally regardless of silver price. Solar panel manufacturers don't stop buying silver when prices rise. They pass costs to consumers or absorb margin compression until they literally cannot afford to produce. Bullish factor 4. The gold breakout is confirmed. Gold breaking $3,000 isn't speculation. It already happened. Gold at $3,150 and climbing isn't prediction. It's current reality. Historically, silver lags gold breakouts by 3 to 6 months, then catches up violently. We're in month 4 of the gold breakout. The silver catch-up move is mathematically overdue. Bullish factor 5. March 15th timing factors. Options expiration cycles, futures contract rollovers, and quarterly rebalancing all converge in mid-March. This creates conditions for amplified volatility in whichever direction the market moves. If silver begins its catch-up move in February, March options and futures dynamics could accelerate the move significantly. The $150 target isn't just mathematical convergence. It's mathematical convergence with timing factors that amplify moves. Where does this leave us? 3 key takeaways, and we're out. Number 1. The mathematical framework is sound. Supply deficit acceleration, 945.5 million ounces cumulative since 2021. Stockpiles at 63% depletion. Industrial demand exceeding remaining supply. The math says current prices cannot hold. Gold-silver ratio at 88 to 1, which is 51% above 50-year average. Mean reversion is mathematical gravity. The question isn't if, but when. Shanghai premium at 47.6%. Retail premiums exceeding 100%. Paper and physical are completely disconnected. Convergence favors paper rising to physical, not physical falling to paper, when physical supply is unavailable. Combined mathematical target, $152.24. That's where the numbers point. Number 2. Historical precedent supports the target. 1980 squeeze, 724% gain, $181 equivalent from recent lows. 2011 squeeze, 193% gain, $102 equivalent from breakout. $150 sits between these precedents with conditions more extreme than both prior squeezes. The math has worked before. There's reason to believe it works again. Number 3. Timing is uncertain, but conditions are ripe. March 15th is a target based on timing convergences, not a guaranteed date. The factors driving toward $150 could resolve faster or slower than modeled. Position for the thesis if you believe the math. Don't bet the house on the timing unless you can survive being early. The unresolved tension is this: when physical markets diverge this severely from paper markets, something has to break. Either paper suppresses physical reality, which requires actual metal to hit the market, which isn't happening, or physical reality overwhelms paper manipulation, which is what happened in 1980 and 2011. The math says paper breaks. The timing says conditions peak in Q1 2025. March 15th is when the convergence factors align most intensely. That's the framework, that's the math, that's the $150 thesis. Now here's what I need from you. Check my numbers, verify my sources, run the calculations yourself. If I made a mathematical error, call it out in the comments. If I missed a factor that invalidates the thesis, tell me. This community gets stronger when we challenge ideas, not when we blindly accept them. And if the math checks out, if you verify the supply deficit, the ratio divergence, the Shanghai premium, and you reach the same conclusion I did, then you have a decision to make about how you want to position for what's potentially coming. Do your own due diligence. Understand the risks. Know your time frame. Know your risk tolerance. Paper or physical. Trading or stacking. Short-term or long-term. These decisions are yours to make, not mine to make for you. I give you the analysis. You make the decisions. That's how this works. If this added value, drop John JD in the comments. If you want more mathematical deep dives like this, subscribe and hit the notification bell so you don't miss updates when things move fast. Remember, we're not here for hype. We're not here for hopium. We're here for clarity in a market designed to confuse you. Invest with logic, not emotion. Stack with conviction, not desperation. And always verify before you trust. John JD out. Next video is on the way. Make sure you're subscribed so you don't miss it.